Now we're going to have our next policy panel. So David Robinson is going to lead the discussion for this panel. David is from Duke's University of Fuqua School of Business and the Duke Innovation and Entrepreneurship Initiative, which serves to connect innovators to education, mentoring, resources, community, and intellectual leadership. David also serves as co-director of the Entrepreneurship Working Group at the National Bureau of Economic Research. We are very pleased to have David and his panelists here who are joining him as they're getting. All right.
I have a mic.
Yep. Getting our mics turned on.
Ooh. You're getting old, Matt.
Old. I got to be springier.
All right. Anyway, I'll hand it off to David, and he can introduce the panel. Thank you.
Fantastic. Thank you very much. As the co-sponsors of this conference, I want to first start by thanking the FDIC, Chairman McWilliams, Diane Ellis, the whole team that put this event together. You guys have done a fantastic job with this, and it's been so seamless and easy to work with you guys that I just wanted to start by acknowledging that. Thanks a lot. We've got a great panel, and I'm gonna start at the end. At the end, we have Amias Gerety from QED Ventures, and I'm starting with you because you're the most recently arrived. You know, some of us got in last night, some of us got in this morning. Amias got in about 7 minutes ago, off a plane. So you know, I guess that's technology speeding transactions.
That's right.
Before our very eyes. Next, we have David Jegen from FPrime Capital. And to my immediate left, we have Matt Rhodes-Kropf from Tectonic Ventures, not to be confused with Tectonic Capital, right? So we've got 3 investors, but part of what I think is so interesting about this panel is that each of these guys comes from a different background before they were investors. So Amias has experience at Treasury as an Assistant Secretary of Treasury. David, you were an entrepreneur before becoming a VC. And Matt, you had a distinguished academic career before becoming a VC. So you guys, I think we have a unique opportunity to have the perspective of an investor, but also kind of a diverse investor perspective on this. And so I'm glad you guys could all join. I thought a good way to start would be to just ask you guys to tell me a little bit about the fund. Oh, actually, before one point of housekeeping before I start. These mics, there's 3 of them. I'd much rather this be a discussion where they were responding to your questions than my questions. Because my questions are just things written on hotel stationery. I'm sure you guys have much better questions. So if rather than me asking people to come to the mics, if you have a question, just come to the mic and I'll see you and we'll take your question and kind of weave it into the conversation. But why don't we start by, Matt, we can start with you and go down the aisle. Tell us about your fund and kind of, Meg was saying in the previous session there, Fintech is kind of like sports. There's a million different kinds of sports. And so maybe tell us kind of where you like to focus and why you like to focus there. Maybe that's a good place to start to kick things off.
Sure. So I teach Fintech at MIT also. So I do still sort of come at this all with a little bit of an academic view to it. But I invest both in Fintech, but also in other things. So I invest some in robotics and other SaaS areas. So usually my theses are not so much around a particular vertical, but more something that's cross-sectional, something that's happening and then forcing reaction to it. Things about technology. So right now, for example, hardware is happening. And so light hardware that creates a software, that then the software adds a lot of value, or Amazon is scaring a lot of different people, and that causes a reaction. So we're looking for responses to something, to a stimuli that's happening in the market that then allows for it. So we're not specifically saying we're doing payments, or we're doing lending, or we're not focused on a thing. Instead, we're looking for something that responds to some sort of critical need that's happening. Within Fintech, we think there were
critical needs is being driven by some kind of technological change, and that's what kind of gives rise to the response. They
can be a technological change or a business reaction. I think so. Like one that we're sort of looking at in Fintech is originally there was a lot of thought around some of these Fintechs were going to come and sort of replace some of the big, there was this idea that maybe, a robo-advisor was going to place some of the big wealth management firms. And I always felt that was a little silly. So instead, we tried to look for things that would help support the wealth managers who were then getting worried about being replaced. So it's sort of in a reaction to that, how could you build and support? So we've got a few different investments that are sort of in support of some institution, whether it be a bank, an RIA, that's then, because the world is changing in some other way, they are suddenly open and much more ready to adopt a new software or new technology.
David.
Do the same. Yep. So I'll introduce FPrime Capital briefly, and then some of the things that we're interested in. But FPrime Capital is a venture capital arm affiliated with Fidelity Investments, a large mutual fund company. And we've been investing, literally this year is our 50th anniversary, so I was not there at the beginning, as old as I may look, but have been doing it for a really long time. And we have teams in the US as well as globally, teams in Europe, in London, Shanghai, Mumbai, Tokyo, Hong Kong as well. So really global venture firm. Here in the US, we have a healthcare fund, and I manage our early stage tech fund. And there, we are half enterprise software and half fintech. Like I would say, although most of my day-to-day life is in the fintech world, in the venture capital world, it's historically been a niche category. It was historically $1 billion out of $25 billion of investment annually, and even though that's 5 to 10 times larger today, it's still a category that is, as we would call niche in the tech world. But we love all of it. So we go really deep and broad. We will invest in capital markets, banking, payments, insurance in most sectors. We are early stage investors, which means we're often investing pre-revenue, but in our case, generally post-product. So some companies, and I think Amias might say they go even earlier, but we generally look for teams that have a product, probably are beginning to test it with customers, and then we would stop investing when they reach a certain amount of scale. We're not a late stage investor either. So, and my own background kind of spans a lot of enterprise software as an entrepreneur and as an operator, but also financial services. So I personally love things that intersect that, and investments where there's a heavy data analytics component, which could be in the lending space, often is in the payment space, where data is being used to create unique insights for vertical payments, for instance. An area we find particularly interesting now is areas like healthcare payments, where we, perhaps because we have a fintech hammer, we see fintech nails, but we definitely see in healthcare much of what has been happening in financial services for the last 5 years will happen in healthcare, certainly in areas like how does money move around and how are loans brought to bear to help consumers, as an example, and how do point of sale transactions move into the provider as consumers lead more of the payment in healthcare.
You think we're going to see health data being used to enrich credit scoring models? If I do my core routine every morning, am I a better credit risk, you think? What do you think?
Yeah, as scary as some of that sounds.
I'm being serious, I'm not, it sounds glib, but
no, there are many companies working on permission-based genomic data or healthcare data, two separate streams really, right? And the healthcare data for sure is happening, and some of it will be used first for non-underwriting purposes, just plain like better insight for doctors, right? So that there's more holistic awareness of the patient that you're seeing, and that's a really natural use case. But once that data has been aggregated, normalized, made available, then insurance companies might step in to use them. Life insurance companies could do so today, although health insurance companies are prohibited from doing that. But I think it is destined, and will be a conversation for an audience like this in the future of how do you monitor that? How do you regulate it?
Yeah, certainly my Instagram would suggest that if I can run a 7-minute mile, that my life insurance rates are lower than they would be otherwise. So I think it's already happening. So thank you for letting me be here. I am many friends in the audience, and so glad to sort of offer the perspective from the other side. QED Investors, we are also, like David, pretty early stage. We are 100% financial services focused, and the legacy of QED is really a legacy of the Capital One DNA. So our founder was a co-founder of Capital One, left, and then 10 years ago thought that it would be fun to invest the proceeds of that success into early stage startups. And it turned out that 10 years ago was a pretty good time to start investing in what became known as fintech. I would think for us, we don't really think of fintech as a meaningful category. For us, we think the category that we're talking about is financial services. And so to the extent that fintech is helpful to understand a certain ethos or a certain way of companies getting built, ultimately things need to either provide better financial services or people need to provide software to enable other people to make financial services better. And so, when we think about our themes, I tend to invest in the second theme, right? So people who are trying to automate the anti-money laundering process or automate loan administration, provide infrastructure for payments, et cetera. And others of my partners spend more of their time focusing on how do we build a better consumer financial app? How do we create personal financial management tools that actually help people really take control of their financial lives? So one of our favorite companies has people at the back end of the automation so that from a personal financial management perspective, you could actually ask the app, is $200 too much to pay for a used IKEA couch? Because if you're a 25-year-old living in you name it city, that is personal financial management. And the typical personal financial management 1.0 of here's a budget and we have analyzed your spending and you tend to spend more than you earn is not actually that helpful compared to having the ability to say, this is what your financial life is, and you can ask us any question you want. A lot of those questions are going to be automated or responded to with a chatbot, but some of them, if we have never seen them before, have human in the loop. And so, where we look at this, we think about where does tech and financial services connect, and we tend to not be really religious about something needing to be absolutely cutting edge from a technical perspective, or having to be too much software, or not being able to be have physical presence, et cetera. So we look at this as innovation can often just be an insight, and insight can drive a lot of value if you deliver it over time in ways that make consumers and make financial services better. So that's how we think, and we cover the entirety of the financial services landscape. Our entire firm is focused on that, and so that's how we approach the ideas. We tend to think, what does the future hold? What do we have confidence about? And then what are the kinds of companies that might win in that future? And then let's go out and see if we can find companies that look like that. So we often will have hypotheses about companies that should exist, but don't yet exist. So I have a couple of hypotheses like that today, where I think that there's a company like this that will be made and will be successful, and I haven't found any such companies yet. And so that's kind of another thing that we think about, is just try to have the ideas. Occasionally we'll actually pitch them to CEOs and try and get them to build. But that's a little bit about our firm.
Awesome. What you described almost sounds like what Jason was talking about in the discussion of the previous session, where it's almost like design thinking meets financial services, trying to figure out what people actually want and then deliver the product instead of just show up at the door and look at when it's open and when it's closed. Yeah,
so my partner Frank gave a presentation last year, which he called the Copernican Revolution in Banking.
Yeah.
And with the extension of the analogy that many banks think that they're the center of the universe, but in fact the customer is the center of the universe.
Right. Well, so that's a perfect lead into what I wanted to ask next is, do you guys see fintech kind of, let me ask it differently, because this question's been asked pretty much the whole day. How do you see fintech disrupting banking, or do you see it destroying banking as we know it? How do how's the banking sector going to change in your mind? Are you guys going to be bankers after the companies that you've invested in become successful? Or how do you see this play out?
The setup is not right for the classic disruption story. We are the classic disruption story, well, you can go into who can be disrupted, but it's, you have to have some stodgy old firm that can't move or change in any way. You can't talk to a bank today that doesn't know that it needs to have an app. It needs to get better fintech. It needs to start using a new technology. It needs to write a new thing. And they're not all sitting around going, oh, those guys with their tech.
Those young kids.
Whippersnappers, they don't know what they're doing. Nobody's saying that. They're all, hair on fire. They're smart, and they have money, and they have budgets, and they can buy a company. I mean, the idea that we're going to replace the old guard banks with new hot banks, it's crazy. We're going to support those banks. We're going to, provide tech into them. They will get a better consumer face. We'll have easier interactions with our apps, as we're already seeing. And so there's room for a lot of innovation to support this whole community. But personally, the idea that we're sort of knocking Wells Fargo out of business or something is not happening.
I think that I agree with that. The risk is kind of who loses, not whether an entire category loses, right? And the Amazon effect, I think, can play out in financial services, which is that the big retailers are still there and they're doing fine, but a lot of small retailers disappeared. And I think that analogy for Wells Fargo won't go anywhere, but many community banks, are more at risk. And that didn't start with the fintech, disruption of the last 5 years, right? Because the top three banks went from 20 to 32% in deposits over the last 10 years, 2007 and 2017, long before fintech had any impact on deposits. So, but I think it can be accelerated, and that's probably the bigger risk of how do they keep up with the technological aspect and the fact that branches aren't as important as they used to be.
Particularly because it's the big banks that have the power to buy the solution that they need. So neither one is going to write it, but a big bank just steps in and says, oh gosh, we really did need that. Let me pay a couple $100 million and pick that up.
Yeah, so you guys
community
see
bank
banks
isn't
as
doing
exit
it.
opportunities, which is why I thought it would be important to talk about this.
Yeah, I mean, we often say there's only 3 sustainable business models: become a bank, or an asset, become a large asset manager, become an insurance company, become a bank, get bought by a bank, or find a sustainable business partnering. Right. So those are your 3 sustainable business models. There's a reason why we have the financial services infrastructure that we do. We have the structure that we do. These are things that we take really seriously. People here in this room take them really seriously. Regulation does provide a certain barrier to entry, but it exists for a reason. And so people need to live within that. So I think that's definitely true. The other thing that I think, just a note on the community banks, I think that the ultimate question will be a strategic clarity question, which is understanding, if you sit in the bank's shoes, what do I have and what can I do that will make me successful? And so one of the things that I often say when I talk to community bankers is I say, remember that you actually hold the key to success for startups. And the reason I say that is that most startups need to solve 3 different problems on their way to success. They need to find a real problem, they need to solve it in a scalable way, and then they need to become an industry standard solution. And those are the 3 sort of legs up. And even a community bank actually holds the keys to the first 2 steps. Now, they need to change their culture. They need to be better partners. They need to make decisions quickly instead of slowly. But if they put that hat on, they realize, well, I have real problems. So if a fintech wants to figure out what is a real problem versus a fake problem, I can actually tell them. And I have this legacy infrastructure, which is not all that different than a large bank. And so I can actually help a fintech understand, what does it mean to integrate into legacy tech and to provide a new solution into a legacy industry. And those 2 things are actually really important to any startup success. Now, of course, the community banks can't drive the industry adoption at a large scale, but if they have that mindset of partnering, I think even small banks, if they get strategic clarity, will be able to succeed. The degree of difficulty is a little bit higher.
I think the core problem, or in substance, what was the giant bank good at and what was the small bank good at, right? When you think about the small community bank, it was all that local information, all that, I know who you are, I know you're going to repay. In academia, soft information, right, versus hard. But when the world, everything is moving from soft to hard, right? When I can, with Manju, when I can see you exactly how you type in your app, and now I know something about you, well, but maybe I learned that now you are kind of the kind of person I shouldn't give a loan to. That would have been hard to figure out before. I can figure it out now. When I know whether or not you do your sit-ups in the morning, I know who you are. When I've learned all that local information that used to be so important, it fades. And that, I think, is the true danger. So they can adopt technology. They can use fintech technology to have sort of similar, like a cute app. That's not the issue. It's like their core advantage, that local knowledge, that it's fading. I can get that local knowledge a different way.
That was my thought also, that it's changing the amount of hard information versus soft information that's kind of out there in the market to act on as a bank. But when I hear Amias talk, it kind of makes me think that maybe there's another side to this, which is that small banks, community banks, they can get a leg up in getting and acting on hard information. And so it's not just that the supply of soft information is shrinking and giving big banks an advantage. It's that now it's sort of cheaper and easier for small local banks to have hard information that they can act on in ways that would be similar to the way a big bank would operate. So
I guess it depends on how freely the data is available.
Yeah, I guess
everybody.
That's right. I mean, it's that, and you guys kind of control that at some level.
Yeah, in fact, data in that sense, hard data is a levelizer, right? A lot of aggregators, for instance, like Quovo and Plaid, right? Part of the battle with the banks is over who owns that data. If the banks can throttle or restrict, even to 90 days as opposed to 9 years worth of data, then they have ball control over that hard data, and that will favor them. If, on the other hand, for convention or regulation reasons, the consumers viewed as they can own all of their data, all that history, then I think hard data is more equally available to community banks and other startups. But it's a critical part of the question.
We've got a question from the floor.
Yes, so the three of us were whispering over there on hard data, soft data issue. This was really not and we're really wondering about community banks and on consumer lending, yes, but what about small business lending, right? And maybe Amazon has all of that from its small merchants lending, but we're wondering over here, and we're questioning whether the hard data, soft data distinction is that it's advanced for small business lending where branches and local knowledge might still matter for a little bit. Anyway, that's the question. On behalf of the table.
It's certainly not as advanced today, but I think it's coming. There are a lot of people trying to build. I'm actually in an investment trying to do small business lending and to figure out that at a way that can be done. We're working with Euler Hermes, one of the largest credit insurers in the world, and we were able to get them to process credit decisions on a small business in the United States in under a minute. And the chairman thought it was amazing. We were still like, a minute? Yeah. But, so there is an attempt to sort of move that way. I think it'll happen to consumers first. But getting data as a business, as a small business.
I think the access to data in the small business checking accounts and transaction accounts is, in a sense, that is the road to probably a more diverse set of lenders as well as better underwriting. It can cut different ways, but in some cases, like Square Capital or Toast, one of our investments, they are the restaurant point of sale system, so they are monitoring data for years before deciding whether to extend a loan, and that's a great way to underwrite and can ultimately lead to very low rates for the small business. But even when you don't have that, other lenders can say, allow us access to your accounts, and we can look retroactively at what your working capital looks like and make loans based upon that. In some ways, I feel that is, again, any lender has equal opportunity to build that underwriting model, and that data levels the playing field with what a big bank might have had.
Yeah, and I think there's going to be different pushes and pulls here, right? The advantage that PayPal has, or Amazon has, or Square, because they sit on top of proprietary data, But in fact, we got a pitch recently from a really interesting firm in Canada where they take they finance ad spend. So if you do digital marketing, they will factor it. And because companies can deliver their analytics to this lender, they take the power away from, only Facebook knows all the ad spend, only Google knows it, and they suck it out. They run the fancy algorithms on top of it, but now they are democratizing the sources of capital for with that same kind of rich data lending. I think the other thing, to go back to the point about who's at the center, is what we're talking about here are individual products. And I do think that there are individual products have a tendency to get commoditized as we move from soft to hard data. But user experiences and customer journeys, which are an assemblage of multiple products, continue to be a way to build brand value over time. And so I think one of the things that we're really interested in when we talk about the idea of a vertical bank, really take that customer journey and then design all of the financial products that sit around that. So one example that we are literally just launching, just the CEO, is a landlord bank, right? A landlord, a small-time landlord, has a variety of complicated financial needs. They need escrow, they need payments, they might need a second mortgage which got some different underwriting on it. Those are the kinds of things that the average landlord cobbles together. And maybe they have a discussion with their wealth management advisor at a regional bank, and that wealth management advisor helps them navigate inside the bank over the course of 6 months. Whereas if you could go to them and say, we understand what it means to be a landlord that owns 3 properties. Here's the suite of financial services. They're all delivered in your phone. They have these things. Now you're creating, even if each of those individual items is going to be commoditized, the customer experience of putting them all together in a user journey that actually makes sense for that person's life, I think can create a lot of value. And I don't think that's the kind of value that is limited to fintechs being able to create. These are the kinds of insights that banks should be able to create if they change their mindset and if they have strategic clarity about this is a segment that we want to go after and we're going to understand them and do, to your point, David, user-centered design.
Yeah. The only thing I would add is I think it depends a lot on the nature of the small business in question. You can think, imagine you're somebody who makes, expensive leather goods and sells them online. You might be really small, not have very many employees, not really have much in the way of accounting that you could use to take to, explain to somebody what your financial needs were. But if you could give me your UPS number and I could look at your shipping history and I could see inventories coming in and orders going out, I could do a lot with that and determine whether you were, a good credit risk. And that starts to look exactly like some of the consumer-facing stuff that we were seeing earlier. Question?
So this is for all of you, but maybe particularly for Amias. I guess the conversation we're having really sort of expands our perimeters, or our thinking about the perimeter for financial services, maybe into other areas. But just sticking to financial services, do you see that solving these problems and addressing it from the consumer's perspective might lead to consolidation across the verticals in financial services, so that you're providing a variety of services, to a consumer who has what were previously provided by asset managers and insurance companies and intermediaries and others, so that the rich texture of the conversation that the consumer has with that provider really spans the sort of the gaps between or among all those financial services. And what are the regulatory implications of so doing? Is that a bridge too far, or is that something that you can see in the future?
So I think it's happening now already. And you can see this with some of the most successful consumer apps that have launched in the last couple of years, right? If you think back to Credit Karma, sort of the grandfather of these sort of consumer referral apps, Credit Karma always just referred you out to get a credit card, get a loan, something like that. It was always just a referral engine. But now, because the infrastructure has developed so significantly, some of the latest apps, right? So whether it's Wealthfront or Aspiration or Coinbase or the Cash App, right? Cash App is now offering your ability to buy Bitcoin. Wealthfront now has a high yield savings account. And they're not referrals. They're literally branded, sitting on top of other infrastructure providers. I think it's really interesting. We don't really know where that's gonna play out. And I do think, especially from a consumer privacy, use of data perspective, there are some unanswered questions. Each of those services is going to be regulated in its way, certainly for anybody who's not silly. But there are going to be, I think, new questions about when do you're going to have access to a lot of non-traditional data in that context and using it inside the four walls, and how do you think about that? I think will raise some interesting questions that have not yet been answered within the verticals of the regulation on each of those products.
Every fintech basically says, we do X, we're Robinhood, we trade stocks. Soon, we're going to be offering you car insurance and life insurance, and we're going to be there.
Yeah, it makes investing hard because your existing investors don't want you to invest in the other one. Right. No, we're going to do that next.
We're going to do that next. Right. It's impossible to not be conflicted. There is a view, but I think it's actually sort of an older view. Like, I use USAA. And I use USAA for my banking, and then because of that, I guess I'll get my life insurance through them. And maybe I won't shop around as much as I should because, hey, it's kind of easier to do this. I think the other view, the alternative is the fintech is making it incredibly easy to do any one of these things. So life insurance, no longer is it incredible pain. You can look, you can get pricing, you can see how you would do, you get the best price. Car insurance, your car loan, all the different aspects that you might have sort of naturally gotten through USAA, I think may very well go the other way. Now, at the end of the day, though, you don't want your life in 200 different apps, but then we'll just create aggregator type apps that sort of show you your financial life. Here's your loans, here's your investment accounts, here's your insurance, So I think there's a world where actually we end up with sort of like lots of best-in-class things because we don't need to just, it's too hard to go searching, I'm just going to use USAA for everything. But but it may turn out that I'm wrong and Robinhood is going to offer everything.
They're going to offer everything.
And people will actually use all of their offerings.
So a lot of the conversation has really been about information advantage and, whether it's fintechs or others. And so, it used to be banks had an information advantage because they could see your checking and savings account. And so FICO now has Ultra FICO, where you can voluntarily give your savings and checkings account and they'll beef it up. And so an alternative perhaps, right, and I'd like to hear your views on this, is just more credible information sharing. So whether I'm a small business or a person, if I can voluntarily give you my checking and savings account, you have the same information as a bank. If I'm a small business and I can credibly show you my order flow on Amazon or whatever, you have the same information. And that would, information aggregation and voluntarily but credibly making it public, it seems that would level the playing field in a different dimension. So, thoughts?
I think that I agree with the premise and think so. Data aggregators that have emerged in the last, 15 years ago with Yodlee, newer versions like Quovo and Plaid, they are in fact doing that. Now they're kind of started with the checking account, the savings account, and the brokerage account, but that's I think a big part of what you're saying. And they, technically, practically sell to anyone, right? I mean, with the right licenses and the right privacy. So there is definitely a level playing field there. I feel, data model has existed in advertising and spending patterns and tracking history as well for even longer, right? So I think aggregation is there. It's not universally distributed, but it's there and only getting more easier to access via APIs.
I think we, if you think about the two big themes that are happening in tech, sort of as it is lived and experienced, right? There's lots of cutting edge stuff in different places, but the things that are really driving change right now is there's a data question and then there's an algorithm question. And the way I think about this is that within each of those axes, you have a proprietary question and a commodity question, right? So there's commodity data, public data from the Census Bureau, from stock tickers, from trading venues, whatever it is, stuff that you can buy. And then there's proprietary data, which comes out of internal systems, business processes, the capacity of systems to now capture really detailed data about what's happening, stuff that used to just never be captured. And then on the algorithmic side, we get pitches sometimes from people who say, you should invest in me because I am the world's greatest expert in unsupervised machine learning. And then you have other people who say, well, even some basic, machine learning is going to deliver a lot of value if we can apply it to this data set. And so I think for us, and this is, I think, maybe a little bit just our lack of ability to ascertain who is the greatest data scientist in the world, we like ideas that put commoditized machine learning on top of proprietary data. So where you're building systems that start to capture what used to be a data exhaust, things that used to just, you never know. And I think that's sort of another way to think about these data aggregation questions is, what are the streams of data that and patterns that today are sort of only captured in the disconnected minds of people, and in the future are going to be captured in machine systems? And then what value can you create if you can capture that proprietary data?
Question, yeah, sure.
Hi, I'm Didi from Capital Munch. I know a lot of the QED partners and hope to see you at the next networking happy hour event. My question is, it's a little bit of a generic question, so just to pull back a little bit. For somebody who's been in Capital One for a while and I've not, ventured into, no pun intended, into the VC world or the entrepreneur world, like from the time, let's say, entrepreneur comes to you guys and pitches, provides sort of, hey, here's the problem I'm trying to solve, here's the solution, here's how I'm going to scale up, et cetera, can you guys, each one of you, kind of give us a peek at, inside the kimono, what's your framework? How do you sort of evaluate that pitch? What's your sort of proverbial top 3 questions you ask to evaluate that pitch?
Sure. I'm happy to go in there. I mean, there's obviously at the end of the day, there's a ton of things. And so there's all sorts of the standards. This is a big market, these kind of things. We're really just fundamentally looking for, first and foremost, are you an expert in that problem? Do you really understand the problem you're solving? Right? Up in the airline, before you destroy my industry, know my industry. And do you really get it? Do you really get the problem that you're trying to solve? And then, can we go and talk to a customer who's going to try to, who you're solving, and have them say, oh, you could do that? Oh, I'd buy that. And that sort of at the core is like, have you thought that through? Do you understand sort of a business model rather than I'm an expert in AI, I'm going to do cool stuff? No. So at its core is like, have you thought through the business model of your business, understand who's your customer, who's going to pay, for what, why, and when? That's kind of what I'm getting at. And when I get excited when somebody really has that very well thought out.
So I'll just add to that. I think that's right. And maybe the second piece for us, and it somewhat varies by stage, so maybe a way we think about it is like seed and A stage versus later stages, what matters most. And in addition to the team, we look for people who spin out product with alacrity, like high velocity. They are really good at building it, releasing it, testing it. And they've shown that before we even meet them, because I think that has changed in the venture world. So much can be done before capital's even raised, that you can actually evaluate the quality and the design sense and the speed. Because they're going to get, the first ones aren't the right ones. It's more about how quickly they change that. When it's a little bit later, we focus more on the sales and go-to-market motion. Like, do they have while it is true that there are some product-oriented co-founders who go on to lead great companies, it is equally true that sometimes it's the sales-driven CEO that builds a great company and gets out of those early stages. And I personally think that separates the good from the next stage of great. And then the final thing is the business model. In the end, there's a lot of businesses that grow up to be good businesses only to find that they are competing in a hyper-competitive market. Pricing never goes up, it only goes down. Sales cycles lengthen, not shorten. And there are some business models that are virtuous. They get better. Network effects is one example of that, but not the only one. Sometimes in vertical niches, you find your model gets more compelling, not less compelling. So we look a lot at business model, and kind of in our minds, it separates maybe $100 million or $200 million company from the ones that become $1 and $10 billion companies. It's often about business model at some later stage.
Yeah, I think that to add on to that, there are two things that you can do as a startup. You can either have a differential promise. I promise that I can do something that no one else can do. Or you can have differential execution. I can do this better than other people. And one of the things that we're often looking for is, do you know which one you're doing? And are you credible? And obviously, in the ultimate, you want someone who can promise to do both, right? This is a differential promise, and our team is such that we're also going to differentially execute. I'll give an example of this, and people who've been around the kind of tech and banking ecosystem will be familiar with it. There's a lot of excitement about blockchain and identity. 2 years ago, people didn't know how to make blockchain plus identity into a viable model from an architecture perspective. There's some work at MIT about off-chain storage and on-chain storage and how to do that. And a bunch of entrepreneurs 2.5 years ago went into their closets and started coding away. And 18 months later, they all came out with the same answer. And they all came to people like me and said, I've got a differential promise. I have figured out how to combine blockchain and identity, and I will be the future. And by that time, I had seen enough pitches to know that they were all doing differential execution promises. And so that really put a lot of these companies in a very hard spot. Some of them are going to succeed. I don't know which ones. But it just put them in a place where it was very hard to fund, because not only was it not clear what they were doing, but it was not clear that they knew what they were doing.
Okay, I'm looking at the clock, and as I was looking at the clock and watching it tick down, I was looking at the title of the conference, Fintech and the Future of Banking. And I was thinking, banks, if you just take a step back, banks are financial intermediaries and move money from one side of the world to the other. And then I'm sitting here looking at you guys, and it just occurred to me, you guys are financial intermediaries also. You take money from investors and you invest it in companies. So can I just take the last 3 minutes and put you guys on the spot for a second?
I gotta go.
So how is FinTech going to disrupt your industry? Or maybe it's not. You can just say it's not, and I'll move on to my next question. But I'm interested to hear how you think about how these same forces that we've been talking about all day are bound to have an impact on the way that you evaluate, select, invest in businesses, and potentially also the way you exit businesses. And I'm interested to hear whether you see yourselves getting disrupted through this.
So I helped, full disclosure, I helped start a company called Correlation Ventures, which uses quantitative techniques to make venture capital investments. It's not the fund that I've been talking about today. It's not how I make my investments, but we are essentially a quant shop for venture capital. So I think there's a great potential for using a much greater data in the decision-making process. I will say, though, that the number one thing that we're doing using the quantitative data is we are essentially credit scoring the lead investor in the round. So I'm not actually taking the human out of the network. We're figuring out, can we determine which human should be making this investment, whether this is the right one, and then can we follow them? So I think that there'll be a combination.
If I knew that you didn't let your cell phone run out of power and you had the gambling app on it, that what if that told me that you were a better CEO?
Yeah. We try to analyze the CEO through networks, but yes, you can be using different things to try to determine if a CEO is good about looking at their networks. So I think it'll help.
Yeah, I find it easier to say the industry has its own level of like disruption and change, not necessarily because of fintech, however. I think it's more that the things that are prominent to me are like size of funds getting larger and the fact that larger funds are able to engineer success in some cases. Like literally the amount of money that goes into a company changes the likelihood of success and can take oxygen out of an industry. Globalization is more real today than ever before. I mean, the number of investors from China investing in seed stage companies in California is at a historic high. So some of those things are changing it. And I do think data is a part of it. Like a VC that isn't factoring in signals from data and looking at early stage companies is really missing out on a source of decision making, right? That should be there. So
yeah, and so we, like Matt, actually invested in a company called CircleUp, and CircleUp is now they originally started as a lending platform, and now they've actually become a venture platform for consumer product goods because they're actually really strong and publicly available data streams around who is selling small SKU innovative consumer products. And so that's an example of this sort of coming for venture. The truth is, I think that there's very little data in many of the early stage investments that we do. People often ask, do you have, analysts? And we say, no, because there's no data to analyze. Right? So I think that, and then I think the last thing that the way we say this to our investors all the time, the money is a commodity. The thing you're looking for is a business partner. And at some level, that is the only defense here. The valuation is going to end up in a competitive market. The money itself is going to be a commodity, and entrepreneurs have to choose people that they want to call when they're not sure whether to fire the person that they hired to transform the company 6 months ago. And that is ultimately the real value that we're selling to entrepreneurs more than anything else.
That's a great note to end on, and I see that we're out of time. So please join me in thanking these guys.
We're out of here.
Thank you, David. Matt, Amias, David.
Yeah, thank you.
Thank you so much for that discussion. We're going to take a break now, so help yourself to refreshments out in the foyer. And I would encourage you to return promptly at 4:15 for our last panel, Fintech and Decision Making.